22nd. Let's kick off this morning with Malia Bengali, founder, MB Commodity Corner. Malia, sitting in London, good morning. With the markets opening in Asia, little changed. WTI is a little bit down, Brent a little bit up, or vice versa. But clearly the markets are still trying to digest the announcements last week by the Fed. Your thoughts, a few days later since that has taken place?
Good morning, Sean. Thank you for having me. In terms of the oil market, I think what's happening with the oil versus other commodities is quite different. As I mentioned in my last few calls, was the oil market is going through a seasonally very strong period. You have very good demand in gasoline, summer driving period. Travel demand is picking up as well. You are seeing more inflation in terms of vehicle miles traveled. What is happening in the commodity context? So what the federal policy, what he said was basically the rate of change of QE is slowing down. So the market needs to digest what is happening. We're still in a very accommodative environment. Monetary policy is still very loose, but the rate of change is slowing down. We've seen that in broad money supply growth, and China has been slowing down, as we've talked about as well. So that is taking the price of commodities lower. The reason why oil price will not fall is because it's very tight right now in a very short period of time. We've seen OPEC plus take about 5 or 6 million barrels per day of oil out of the market. We have US picking up from its summer driving season. We have Europe opening up, UK opening up, and travel demand picking up. We're still not in a shortage of a market, but in the window of next 2 or 3 months, we see oil market tight. So oil market will not fall as much as copper, iron ore, or lumber because it is actually driven by a sort of seasonal demand period. But from an inflation point of view, macro point of view, I think we need to take into account what the Fed has said. There's something has changed. They are talking about higher rate hikes into next year. We're talking about inflation being quite sticky and not transient. And that can actually change the whole inflation dynamic. They need to see lower prices. So it's a tale of sort of two stories. People look at copper versus oil and say that oil price should fall. But the oil price is very seasonal. So there might be a delayed reaction. I think oil price could probably fall after the summer demand period is over. But right now, it's very well supported.
Well, let's leap right across to the other side of the world to Peter Maguire, sitting in Sydney, Australia. Peter, as CEO of XM Australia. We have Brent trading this morning, Peter, above $75 a barrel. The market looks very happy, very supported. But we had the news overnight of China cutting crude oil import quotas for the second half of the year. Doesn't seem to have taken a step out of the market. Your thoughts?
Well, good morning, Sean. Good morning, panelists. No, it certainly hasn't, Sean. 75 is a little bit of a yaha, let's have a party sort of number. We've been waiting for that to happen for a number of months. A lot of people were very anxious about, and certainly the long traders didn't think it was actually going to happen. And here we are before the end of June and it snapped 75.15, I'm noticing. And even with that, the US dollar came under very, very solid move to the upside in the last couple of trading sessions, back above that 92 handle as far as US dollar index. So if the US dollar was back at 90, I think that there's every chance you would see possibly a 76.5 handle on Brent, and NYMEX might be even at 75 itself. So there's the first part. The Chinese numbers, yeah, they take it on the chin. The realization is that the world is opening back up, demand is picking up, and it seems to be a feel-good over this Northern Hemisphere summer season, Sean.
Peter, we've saw at the Fed decision or the announcement of the forward guidance, if you like, altering last week. It's clearly the equity markets are still digesting that, but oil doesn't seem to have had any real issue with it.
It seems to be dislocated from the equity markets, and I'll explain one thing. This time yesterday, Nikkei's down 3%. I said, 3.2 nearly. It's up over 3% today, and everything is green except for Singapore, or Hong Kong, I should say. So it's been a very solid move as far as Asian equities today. We saw a good move overnight as far as New York equities. Dow, S&P, and Nasdaq were all bid up. So again, the inflation story is there. I think the overall confidence is there, and that's the issue as far as the taper. And will we see rate rises as early as the end of 22 or mid 22, Sean, or do we wait till sometime in 23? The jury's still out on that one. Traders are enjoying the market and profiting very well from them.
Laurie Hatayan, Middle East North Africa Director for the Natural Resource Governance Institute in Beirut. Laurie, we had overnight or yesterday the first comments from the new president-elect in Iran, essentially putting out his position on the negotiations with the nuclear talks, which are now in a suspended phase. Your thoughts on where does that go and its outlook for the region and the markets?
So basically, nothing surprising there. We were expecting from the future supreme leader to be really a hardliner and to have hard position. So basically what he is saying, the US needs to recommit to the JCPOA. The US needs to remove all the sanctions without any conditions. The US needs to give us guarantees that it will commit and stay committed to it. And the US should not discuss with us the ballistic missiles and our regional proxies. So therefore, what is left for these negotiations? So this is a very hardline position as a beginning as an entry for the new president, expected to be like that. So that will complicate a bit the negotiations. So if we were thinking that maybe we will get to a deal by the third quarter of this year, maybe that would be a bit delayed. And that means like every time that there's a delay in the negotiations, a delay in Iranian oil coming back to the market officially, legitimately, transparently, openly. So that will have, I think, an impact on the oil prices, and we will see oil prices going up because Iranian oil is not coming, shale is not coming. So and OPEC is controlling or managing efficiently. So you will see all these prices going up or supporting the prices going up to $80, $100, as a lot of analysts and banks are saying.
And Laurie, your thoughts on, I mean, there's been some views in both directions. Who has the upper hand and leverage in these negotiations in Iran? I mean, obviously Iran under severe sanctions, economic stress, but yet they've maintained a fairly robust posture, which is their nature. Joe Biden is up against his own limits. I'm wondering, from your point of view, where's the leverage? Who's got the upper hand in these talks as we now finish, I think it was round 6 yesterday?
Look, the issue is, I think, now that the Iranians or the Iranian president needs to really show a hard position and be up to the standard and up to the expectations of the hardliners that have elected him. And the first thing he said, I'm not interested in meeting with Biden, even if there are like the right circumstances. At the same time, Joe Biden, as you said, Sean, he has elections, and he doesn't want to look soft on Iran because he might lose elections. So we're stuck in that position today between these two interests, local, very national interests that are really taking the upper hand on the negotiations. So we will see this situation going on. That's why for the present, I don't see like real, I know that both want to show that they are going into negotiations and they want to negotiate, but I think at this stage it's negotiations for negotiations without going anywhere.
Well, Leah, we have what might move the needle this week in terms of market direction. Obviously, the Iran talks are a little bit stalled. We have the Fed chairman, Jerome Powell, coming before the Congress. What is he likely to say, and how it could impact the markets again as it did last week?
I think the Fed was caught by surprise as to how sharply the market reacted after their commentary about the rate hikes. I think they might try to walk back a little bit of their talk. We've seen some of the Fed coming out yesterday talking about how monetary policy is accommodative. So they might be taking a back move of it. But what's really interesting last week from a point of view is that we had a quadruple witching. The markets, most people don't talk about it, but it's very important for the quarterly expiries, March and June. We had S&P options expire. So there's a lot of negative gamma, which actually went away at 4,200 with the Fed commentary that caught people by surprise, the dollar rally that caused a sell-off in equity markets and commodity prices. That's really important because people actually don't put enough importance on the options markets. But I think from a Fed point of view, I think they will try to sort of walk back a bit for a bit of the comments. But in long-term stories, they are talking about this inflation being not transient. They are going to be looking to take a bit of the foot off the pedal. The repo market, they also raised their IOER rates, which is important because the repo market has been flooded with excess liquidity. So the Fed's taking the step in the right direction. They may not be very fast in tapering because they would not risk a collapse, but the needle has moved in the right direction. So that is our thoughts.
Is there a view? I mean, that obviously the Fed has to maintain a clarity in its communications. It wouldn't want to get into a situation where it feels like, oh no, I didn't really mean what I said, or that type of fudgy language, and then everybody gets a little confused.
Well, the thing is, the Fed, end of the day, they're still buying $120 billion of assets every month. There's still a lot of QE. The balance sheet right now is in excess of $8 trillion. So them saying they're getting a bit more cautious in terms of putting the foot on the pedal, it does not mean that monetary policy is getting, tightened in any way. We still have a lot of liquidity in the market. So I think they're going to temper expectations, which is very good, but it will not be very aggressive. The market reaction was exacerbated by the quotable witching, but I think the market will be supportive right now because there's too much liquidity in the market. That is the main problem. And we've seen that for the last decade. The minute we have a lot of liquidity, the markets stay supported.
Peter, we've seen obviously some very tangible demand growth in terms of the aviation numbers now in the US, up above 2.1 million, which is below the 2.6 million daily traffic in the US before COVID. We've got the European aviation now up to about 50% of pre-COVID levels. I mean, as this tangible demand comes over the third quarter and more of it comes back, it's hard to see what caps this oil price from getting to 80.
Well, Sean, sorry, did you want to add anything to that?
No, I was just going to say, do you identify anything that could?
No, I don't, because I think that the overall demand picture is really picking up so quickly. I'll take my first flight tomorrow. I'm going interstate on a flight, but that'll be the first time since February of last year. So that was pre-COVID. So I think that the world is very much engaged, and very certainly across Australia, people are flying in and out of different states. We're not flying that much overseas, but it's a big nation. Now, when you're looking at Eurozone and you're looking at America, these numbers, I think, will only increase month on month. And as you mentioned, 2.1 versus 2.5 or 2.6 million, you're not that far behind. So that re-embracement as far, and another thing, which really is that's really going to drive, I think, consumption more than anything, is the pent-up demand of the young people and old people my age, that old, Sean, the old people that want to get back to Europe or want to get to travel, and they say, well,
I'm young like Laurie. What are you talking about? I'm 25 like Laurie.
Exactly. I'm 35 this year.
There we go.
So there's the issue at hand. Everyone you talk to has only got one agenda, and that is to turn up the fun meter. That is to do stuff now of what you have been denied, and are you going to be denied that over your life? I think.
What about the Chinese on that? I mean, in terms of, they used to were pre-COVID our of the world's biggest tourism travelers, and literally hundreds of million a year.
Yeah, exactly right. I want to ask our team, very much based in Europe, whether they're going to see the Chinese like they do traditionally around, the Eiffel Tower, into the Parthenon, around Rome, and so on. Those big tourist points, and I'm not sure whether you're seeing them in the Middle East. Have you got any?
The Dubai airport is still at a traffic level of 20% of pre-COVID. June 2019 was about 8 million passengers for the month. This month of June 21, and it'll be about 1.5. So we're about 20%. But the forecast, according to the CEO of Dubai Airports, as announced yesterday, is to get up to 80% of that capacity by the fourth quarter. But Laurie, all things considered, we have an OPEC meeting next week. Clearly, at this occasion, they're going to have to put some cards on the table. What do you think will be their decision, or what should their decision be, do you think?
Well, that's a very hard one. Sorry.
Let Laurie take that one. Let Laurie take the hard questions. I'll give you the easy ones.
I want the aviation question, and he takes OPEC and what OPEC wants to do. So, you say that they need to put cards on the table. Like, I think they will hold on to the cards as always. And I think, again, like what Prince Abdulaziz has said, I want to see demand before anything happens on the supply side. And they want to really see demand and real demand and growth until they come back. Today, OPEC Plus, they're very happy with 70, 75. They have suffered a lot. And when they suffered, nobody, who was there for them? So they were on their own to really take action, decrease production, etc. They took it really hard last year. So this year is their year. They want to enjoy these prices as much as they can. So today, as Peter said, everybody wants to go out, young, adult, elderly people, everybody wants to go out again, and this is summer season, etc. So for them, as long as people are not thinking about inflation, are not thinking about like everything is expensive, on the contrary, I want to go out and live and spend all of that. So OPEC Plus will be happy to see all this increase in the oil and not affecting the economy. So as long as they can keep this thing increasing, they will do that because they feel that this is their right. They suffered a lot, and today they need to compensate for that. So this is what we see. And definitely demand is growing, yes. And they know that Iran oil is not coming back. And today, even with the Chinese decision on the quotas to the independent refineries, as you know, Sean, the independent refineries were buying like these, if you want, the Iranian and not legitimate oil. So that is again something that will be out of the market again. So shale is not coming back. All of this is supporting OPEC Plus. So they will hang on there. They will hang on for another month if they can, since they're meeting every month. So for another month, it's okay for them to see prices even going to $80. They feel that they deserve that. And later they will see, because since they're meeting every month they can take decisions. So I think they will be enjoying the meeting.
Malia, your thoughts on that? I mean, it's an easier decision in a way that there's pretty much clarity now that the Iranian barrels are not coming anytime in 21 to be of serious impact for the market. Shale the same. So the pathway is clear, the runway they have in front of them, and yet prices are from a relative point of view, quite high, and certainly from an emerging markets point of view, very high. Do they need to take those into consideration? Sure, certainly Peter might be able to put his swimming togs on and fly halfway around Australia because the Australians have lots of money. But in India and in the other major emerging market economies, $75 is a lot, especially when the dollar is strengthening.
I agree with Laurie. All the points she hit was spot on. I think they have the opportunity to take a time to do the increase or not. One thing about the Saudi minister talk about the oil demand. Oil demand is picking up, but one thing they cannot actually quantify is the demand coming from commodity index fund flows. In a reflationary environment, we see a lot of passive money going to commodity funds, and this always exacerbates oil price trend to commodity price trend. That's something OPEC has never been able to get it right. When when money comes to the market, things get exacerbated on the upside and on the downside. So when he talks about the oil demand, I would argue that there's actually a lot more demand than even the oil data is telling you, because there's a lot of generous money coming into the market, which is why I think they would never look at that and adjust their policy. So I think it suits them to let it run right now at $85. I mean, they have worked really hard to get the prices up here, and then the swing producers. US shale cannot come back right now. Investors are not going to let them produce. They're being capital disciplined right now. OPEC is the only one that can release those barrels. So I agree, prices will nudge higher, and they have everything in their power to just sort of take it slowly and take 1 month at a time, because the prices have not gone very far. But inflation, at some point, the US consumer will be paying, because obviously you have gasoline prices at the pump quite high. But we don't have President Trump. Last year, President Trump was very vocal about telling OPEC to increase their production. This year, we don't have Biden interfering in policy with the OPEC, so they're taking their own independent decisions. So I do think oil prices can nudge slowly higher and higher. But the commodity index side flows are very important, because that exacerbates the demand, which most people don't quantify.
Peter, I just want to get your thoughts on this. Obviously, we had the comments earlier about the cutbacks in the Chinese quotas for the independent refiners for the second half of the year. But we also have announcements this week of the China's first energy options open to foreign traders on the Shanghai International Energy Exchange. And we have this sort of structural shift in some way, more transparency, more regulatory oversight. How do you sort of summarize that in terms of where China is moving in terms of market management?
Well, Sean, if we highlight last week, which was a very interesting point, we saw copper from the strategic reserves released to market for the first time since 2005. We saw zinc and aluminium, I believe, since the first time since 2010. These were very similar strategies of what they did over the last couple of decades with pork, of course, with the SARS outbreak. So there's the first point. And China has been very strategic with its Maliham, probably will add certainly some significant horsepower to this, that they've been very, very fortunate to buy very, very cheaply over the last year, all base metals and energy. So as they really bought as much as they could for as cheaply as they could. So they've done very, very good strategic buying, and it's been to the betterment of their country. The second part, as far as new markets opening up from options trading and futures trading and exchanges, maybe it's just going to be a change.
Can we expect that that going forward there'll be less activity on the dark side, that the transparency for the market will become a lot more predictable? The case in point being the Iranian barrels, they're rebranded, we don't know how much there are, and so forth.
Exactly right. And it's probably China's way of demonstrating, very much on the front foot, that we're very mindful of across, from a military perspective, from a financial markets perspective, from an economic standpoint. They've certainly marked their territory, and they're growing their territory very aggressively. And possibly their mindset is, let's take on ICE, let's take on NYMEX. And, is this where we are in the next 5 to 10 years, that we are the #1 exchange in the world? I don't know, but it's certainly it's very strategic.
Let's bring up the survey question and give everybody a chance to comment on this Fed issue. With all eyes on the US Central Bank this week to calm market volatility, the question is, was the market reaction to the Fed's June meeting too extreme? Or, and some might argue, not extreme enough. But nonetheless, was the market reaction, as Malia sort of indicated in earlier comments, it was somewhat extreme, or was it? What's your view? And welcome your thoughts on that. Laurie, our EastMed update, we have some noise in the media since the Erdogan meeting with Biden last week about the withdrawal of foreign forces, foreign militia from Libya. Your thoughts on that, and the general dynamics with Erdogan in the EastMed after the meeting with Biden?
Again, we're still waiting to see what will come out of this meeting, and where Erdogan will decide what kind of policies and politics and position he will take in the region. He was very harsh on the Libyan foreign minister when she asked for all armies to leave Libya. And then that is kind of settling down. She was invited to this Anatolia diplomacy forum that was taking place last week or this week. So that is a good sign that things are getting back to normal again. So Erdogan is more open to Egypt. They want to discuss the region, etc. So I think he knows that the US is not on his side. So he needs to be really careful and not to be aggressive. But the other thing I think that is interesting that will happen this week, I guess, or the coming days, it's the new foreign minister of Israel going and doing the first official meeting in the UAE. And that is really interesting as well. As you know, before the new government, we had a mubadala agreeing on buying stakes in the Tamar field, the Israeli field, for $1 billion. And now I think the first official meeting that will happen with the foreign minister of Israel going to UAE, I think that will be kind of an interesting meeting to see how this relation between the UAE and Israel will strengthen and how it be reflected on the energy sector. You know, like there are different projects between Israel and the UAE, not only the Delek deal, the Delek or Tamar deal, but again, like the pipelines from the Red Sea to the East Mediterranean. So all of that is interesting in the region to see.
There's also some talk. There's also some talk again, and it's one has to be careful not to be caught in this sort of maybe, and that's the end of the Yemen war. There seems to be some talks in advanced stages between the Saudis and the Houthis. Do you put any store in that? Is that going to have any breakthrough, do you think?
So that will be part of the Iran-Saudi Arabia negotiations. Again, let's see how the Iranian president will position himself on the negotiations or the discussions with the region, because the Iranians were always, or at least the hardliners, were always from the position that these are regional issues that should be that regionally. And without the US influence or anyone's influence. So let's see what will happen. So I think this is more of the future of the Saudi Arabia-Iran deal. But again, not discussing the missile, the ballistic missiles, not discussing the proxies. If this is the position of the new Iranian government, is it the position vis-a-vis the US or again vis-a-vis the regional forces as well? This is something to watch for, to understand like where the negotiations or if there will be a deal and an end for the war in Yemen.
Yeah, as we see the equity markets volatility over the last few trading sessions, plus a few percent, down a few percent, and so forth, where is inflation at this point, do you think, from the temporary versus the sort of long-term adjusted structural inflation, and how the Fed need to manage this going forward?
So coming into June, we saw inflation at highs of 3.8 to 4.2%. But into June, we've seen break-even inflation rates on a 2-year, 5-year basis come down a bit. Now, this is really interesting because in June, we've seen the whole cyclical reflation trade actually take a step back, or you've seen commodities take a hit back, or technology has done really well. So this rotation, this unwind has actually hurt a lot of hedge funds who've been very long cyclical. So the question is that, has this moved down in breaking inflation rates? Is it something short term, or are we going to see a lower move down? That all depends on China and commodity prices and how slow how they're slowing their prices right now. But we have seen inflation come down a bit, which is helping obviously this transient theory. But we need to see a bigger move down to see it. But right now CPI is probably close to 3.5 to 4%. We need to see lower prices for that to come down.
Let's have the survey result and give Peter the last word this morning. Survey result tells us, was the market reaction to the Fed's June meeting too extreme? 2-1, yes. The question, Peter, or the answer there, your thoughts also on the outlook for the dollar, the euro. I mean, clearly the Fed signaled last week that they may be the first one into a tightening cycle, and the euro, the sterling may be a laggard. However fast this happens, but from a currency point of view, we could be moving into a stronger dollar cycle. PMIs coming out tomorrow in Europe. So your thoughts on the direction of travel for currencies?
Well, Sean, and first off, just on the last couple of days when that announcement came out by Jay Powell, there was no doubt that all the traders jumped all over it and they really ramped it down. So they sold equities, they bought dollar, gold capitulated to 1760. So that's just something there that was really, that 48 hours was breathtaking. And even yesterday was a real wake-up call, what we saw in Japan, but they certainly bounced today. Where is the dollar? I think it's got the capacity of maybe a 92.5, 92.6 over the next week and a half. I think the reasoning is that I'm interested to see what Jay Powell says over the next couple of days and those euro numbers. So I think that the overall strength is going to be there, a little bit of a push to the upside for the dollar. It may go back to 91.8 in the short run, just as a little bit of profit taking, and then it'll bounce. So that's what I'm thinking on. I wouldn't be surprised to see gold trend higher again, Sean, over the next couple of months. It's been the best trade ever. Crude, you don't make much money out of because it's very much range bound, but gold has just been extraordinary.
Well, there wraps up our session this morning. I think that may be the first 30-minute podcast in which the word COVID wasn't mentioned. I'll have to go through my word search, but it does strike me that for whatever that means, it means something. Peter, thank you so much for joining us from Sydney, Laurie from Beirut, Maliha from London, three of my favorite places in the world. Hopefully we'll get to them soon, but we'll catch up to you over the coming days each morning. Thank you very much and have a good day. All the best.
Thank you.
Thank you. Take care.